Hello everyone and welcome back to the channel. This is Fair Value Finder and today we're taking a look at SOFI Technologies. This is another stock that was requested and another one where I feel like it's going to be a pretty short video. Now, financial stocks are a whole lot harder to analyze because the financial portion of the business is completely different from most. But as with any other company, the most important things here are earnings and cash flow, both of which this isn't a very good company for. So earnings yield negative 5.38. Clearly, they lost money this last year based on their earnings. We see that it was 36 cents per share that they lost. And then this year they're expected to make 8 cents, 2025, 23 cents. They are expected to go positive, but not to a very large degree. Cash flow yield, they spent a whole lot of money. Burned through $7.3 billion while top line was $2 billion. Definitely not what we want to see. If we look at the cash flows here, continuously negative, and they're kind of holding at that $7 billion level. So that right there is the biggest red flag to me. I would not touch this company with a 10-foot pole based off those revenues and those cash flows. It's definitely a recipe for disaster. I mean, losing money, all of these are negative. Some of them to a small degree. Their return on assets was negative 1%, which is kind of rough for a finance company where your whole business is building assets and earning a return on them. Debt to equity with financial company, we can let that slide. That's not important. They hold higher liabilities than other companies do. We have no gross margin because they don't have a cost of goods. And the net margin, they lost money, so it was negative 16%, better than the negative 27 that we usually. Revenue growth has been great for this company, double digits consistently. It looks like we're expecting something in the realm 13 to 15 over the next 2 years. So we're going to go with 14 for our thesis. Share count, we definitely don't like to see a growing share count. At least the rate of growth is on the decline. Hopefully they can bring it below 4%, if not lower. Ideally, they're buying back shares, but they can't off the cash flows that we've seen. Cash flows, they've been holding at that level. I'd like to see them get a little bit better. If they can just have a negative 1% annual growth in those cash flows, it's starting as a negative. So this is progress towards the positive side. It'd take them to a cash flow yield of negative 172%. About half of what they came in at this last year because of the growth in the revenues and the growth in the cash flows as well. It gets really tough on the balance sheet. They've been growing assets somewhere in the realm of 50%, 48 to 58. I don't think that that's going to stay high forever, especially as it grows larger. But 50 seems pretty fair based on what we're seeing. But in the same vein, liabilities would be growing 75. If we use the same methodology for the liabilities, we're looking at 76 and almost 82. So we'd have to be going somewhere around 77. I put down 75 because I'd like to see them come in lower than they have historically, but it's still pretty close. But even that is not going to benefit them in any way. And margins, we'd like to see them trend towards the positive direction. If they can get better by 5% per year, then in 5 years, they'll be at 12.5%. So they could potentially get better on that. Current price is just shy of $7. They've been as high as $11.70, as low as $4.45, coming up with a fair value of negative 21.91. It's negative earnings and negative cash flows. And you can't even really factor in a balance sheet for a financial company. There's no value here. If I wanted a good stock in the financial space, I would definitely go with PayPal and go check out the video on that. Even if we can get the margin to come to break even with the trend, the liabilities outpacing the assets as they are, this stock becomes more and more worthless by the year. What we would really need to see is a flip in this whole situation here and say that the assets are growing. Even at the same pace of liabilities, you're actually positive in the 5-year. But if they're outpacing and we see 75 in the assets and 50 in the liabilities, well, then we have a whole lot better of a situation here. We're positive in the 3-year, almost with market return. And in the 5-year, it's blowing it out of the water because this is some insane growth in the balance sheet. Probably more in line with what we would see would be something more like 20 and 10, a lot more reasonable. Still, you're not looking at anything. In 6 or more years, there might be something to this company, but there clearly is not at the moment and with what we're seeing out of them. So what they need to do, they need positive margins, asset growth outpacing liabilities, and cash flows going positive as well. So everything here is a red flag. Definitely not a stock that a reasonable investor would touch. So with that, I want to thank you guys for watching. Please like, enjoy the video, comment what other stocks you want to take a look at, and subscribe so we can stay up to date with everything. And I'll catch you next time.